Today, I will explain the idea that allows ordinary individuals to become millionaires and pass on their money to their children. Compound interest is a simple concept to understand. The strongest force in the universe is compound interest. Albert Einstein is said to have said, "And he knows it earns it, and he who doesn't pays it." In today's video, I'll explain the magic of compounding, provide examples from the workplace, and demonstrate how you may leverage its potential to produce money. But first, if this is your first visit to our Smart Stocks Academy channel, please accept my warmest greetings. Hit the like button, subscribe, and click the notification bell next to it to be the first to know when a new video like this is produced. So if you're ready, let's talk about compound interest. So what exactly is compound interest? It is the act of reinvesting in asset earnings, whether through interest, capital gains, or dividends, to generate further earnings over time. As a result, the investment will generate earnings from both its initial principal and all past earnings, resulting in exponential growth. A snowball rolling down a slope is the best way to envision this. It may begin little, but as it rolls, it gathers more snow, increasing its size and allowing it to gather more snow still, finally developing the snowball to a significant size. This is also true when it comes to investing. The more money you put in, the more money you'll make, which then you can reinvest to increase your earnings even more. This fact demonstrates why it is critical to stay invested and reinvest earnings in order to benefit from compounding growth. The most critical factor, though, is time. In fact, the longer you can keep it going, the more dramatic the compounding effect becomes. Warren Buffett's investing career is the best example of this. He has a net worth of more than $100 billion at the age of 91. Surprisingly, beyond the age of 55, he had a net worth of over 99%. If you plot his net worth over time, you will notice that it grows exponentially, the most significant gains occurring in the later years. His life is a living example of compound interest, and he credits his success to grasping the concept at a young age. When it comes to compounding, time is crucial, which is why you should start investing as soon as possible. But even if you're older, the important thing is to get started so the snowball can start rolling. So where do you start? Why not open a savings account? While this is preferable to wasting all of your money, it is a bad method to practice compounding. It provides a low-risk way to earn small amounts of interest, but your money will lose value over time. This is due to the fact that inflation eats away at your purchasing power quicker than interest grows. The annual rate of inflation is currently approximately 8%, and you should keep in mind that inflation accumulates. First and foremost, you must beat inflation. The best way to do so is invest in productive assets. Something that can generate profits and cash flow, such as a business, a farm, or a real estate, for example. What if you have no experience with investing and don't want to be the next Warren Buffett? Fortunately for you, SP 500 is an index fund that contains 500 of the country's largest public corporations. This is a simple approach to purchase a piece of American business that pays out handsomely. Compounding occurs on several levels in this case. Dividends are a portion of a company's earnings that it returns to its shareholders. In comparison to the pure price return, when you reinvest these dividends, you get a total return. The compounding effect will be aided by dividend reinvestment. Companies will also keep their profits, which they will put back into the business in order to boost future cash flow. Within each organization, this is a type of internal compounding. Companies will also engage in share repurchases, increasing the relative worth of each share held. The compounding impact of stock investing is created by all of this, as well as the organic expansion of enterprises. If you invest $1 in the SP 500 in January 1970, you would have had a total return of $182 by 2020. The rate of growth grew substantially in the subsequent years, as can be shown. At work, this is the compounding effect. Imagine the incredible value that could be created if you invested larger quantities of money or invested regularly over time. So how would an SP 500 investment perform today? So, let's run some numbers based on the SP 500's historical data and project them forward for the next 35 years. So using the current price, current annual dividend, compound annual dividend growth rate, and a conservative estimate for the compound annual growth rate of the stock price, a one-time investment of $1,000 over 35 years will have a total value of $16,000 if dividends are reinvested, and more than $11,000 if dividends are not reinvested. Despite the fact that SP 500 has low dividend yields, it nonetheless contributes significantly to the compounding impact. When dividends are reinvested, the overall value increases by 46%. The difference between reinvesting and not reinvesting is expanding exponentially in recent years, as is the rate of growth. As a result, the longer you can compound, the better your outcomes will be. Let's take a look at the outcomes of a more consistent investing technique. What if you put $1,000 in each month for 35 years? When we reinvest dividends, we end up with a total value of more than $2 million. And when we don't reinvest dividends, we end up with a total value of $1.8 million. When dividends are reinvested, the overall value increases by nearly 28%. Because many of our investments are older and haven't had as much time to compound dividends, the disparity is smaller. Overall, this appears to be a straightforward way for a multi-millionaire to retire. You don't even need to know anything about investing, other than the knowledge that you must do it. Next, I will be explaining how my favorite investing approach, dividend investing, has a tremendous compounding effect. I use a dividend investing strategy, in which I buy in high-quality firms that boost their dividend payouts regularly over time. Companies like Coca-Cola, 3M, Procter & Gamble, Apple, Microsoft, and others fall within this category. The major reason I appreciate this method is that it allows you to generate cash flow without selling your stock holdings. In addition, the yield could be significantly greater than the SP 500, which has fewer dividend payers and is more susceptible to dividend cuts. When dividends are reinvested, this method provides a substantial compounding effect. Now that we've had our fill of talking, let's see how it goes at work. I'm going to utilize a model of KMB stock, which has a long history of paying dividends and is one of my more recent investments. I'll be entering the data from my purchase date, such as the price, annual dividend, dividend CAGR, and stock price CAGR, which you can see here. Then, I'll extrapolate this for the next 35 years. Let's take a look at how a $1,000 one-time investment will perform initially. When you reinvest dividends, the overall value is more than $25,000. And if you don't reinvest, the entire value is $9,600. This is a more than 160% increase solely due to dividend reinvestment. Because the dividend yield is higher, and hence plays a larger part in compounding than in the SP 500 example, the percentage rise is substantially higher. The idea behind this is that when you receive a dividend, you buy more shares of the stock, which increases your next dividend payout, increasing the amount of shares you can buy next, and thus boosting your payouts even more, producing a snowball effect that compounds over time. You can either keep reinvesting your dividends and see even more passive growth, or you can start taking out the payments at this point. Even if you cease reinvesting, your payout will increase over time as the dividend is increased. If you invest $1,000 per month, you'll have a total worth of more than $3 million if you reinvest dividends and approximately $2 million if you don't reinvest dividends. Reinvesting dividends has resulted in a 94% gain in overall value. Because many of your newer purchases haven't had time to compound, it is lower in this example. After 35 years of reinvesting, you would be collecting $65,000 in dividends per year, representing a 16% return on your investment. This is why a dividend investment approach appeals to me. You are producing a lot of cash flow without selling any of your stock. Even if you took the dividend to cover expenses, you would still get dividend increases and benefit from the internal compounding impact of owning the company. It is vital to keep in mind that your outcomes may differ depending on business and tax situations. Fortunately, if you invest in a Roth IRA, you can protect your money from taxes. I hope this video inspires you to start investing and start building that money snowball. And with that, today's video comes to a close. To express your love and support for this video, click the like button below if you haven't already. Also, subscribe to the channel by clicking the subscribe button below and clicking the notification bell right next to it to be the first to know when a new video like this is released. Thank you for taking the time to watch, and we hope you enjoyed yourself. We look forward to seeing you again soon.